There's a lot of speculation they're going to be cutting back in these regulations. Let me ask the most basic question. They're to comply with Basel III. How much leeway is there to cut back and still be consistent with the commitments?
So there's a fair amount of leeway, David, particularly in the proposals that the three agencies made last year on the credit side. They went well beyond what Basel III had agreed to. There's a little bit less room in the other areas, that is operational risk and market risk. And actually, I would not be surprised if on operational risk, the agencies depart some from the Basel Agreement. Because to be perfectly honest, the Basel Agreement on operational risk was not especially well done.
So what do you expect, speculating now, what we'll see when the next round of proposals come out? Will they be cutting back on the reserve requirements?
Oh, sure. No question about it. I think Chair Powell has made no secret of the fact that there'll be substantial changes, which net means a significant reduction in the required increase in capital. But I do expect that the amount of increase will vary quite a bit depending on the business model of the bank. I think you can expect to see the banks with most market risk, that is trading activity, capital markets and the like. I think you can expect that their requirements will go up more than banks that are straight traditional lenders, where most of it's traditional loans and deposit taking. On the operational risk side, I still fear that we're going to have a little bit of a perverse outcome where some of the banks that have de-risked get hit a little bit by the operational risk charges on things like wealth management. So I guess I would say if you're a bank with a lot of trading and a fair degree of non-credit operational risk, you're probably going to see your capital requirements go up more than anybody else's. If you're a traditional regional bank, I suspect the increase will be very, very modest.
Dan, we've seen some back and forth between the first Trump administration and then the Biden administration, and what may well be, let's be honest, a possible second Trump administration. If Donald Trump is in fact elected, how might that change the calculus?
Well, in the first place, David, given the intent to repropose, it's very unlikely that a final rule could be done before the end of the year, much less before Election Day. And so if past patterns hold, there will be a kind of hold on regulation, and it would await the Trump appointees, certainly to the FDIC and the OCC, to make their own decisions. So that probably means that at the very least, there'd be a further delay, and you could quite possibly have additional changes.
This week, we learned who the nominee for vice president on the Republican side would be as well, JD Vance, the senator from Ohio. And normally, I would say, well, it's a vice president, let's not worry about it. But he, as I understand it from you, has had some things to say about banks.
Oh, sure. He's on the Senate Banking Committee. And you would make a mistake if you tried to just slot him as bank or industry friendly or antagonistic. I think he has his own set of views. He's said some things and signed on to some bills that are kind of pro-regulatory. He evinced some skepticism about the growth of very large banks. On the other hand, obviously, in a lot of areas, he thinks there's been too much regulation. But I would say on banking, there's at least a chance that that's one of the areas, because of his service on the Banking Committee, in which he takes a real interest if the Trump-Vance ticket should be elected. And that might mean that the positions of those appointees I referred to a moment ago are not quite as predictable as we might have thought a week or so ago.
And finally, Dan, let me return to something you and I have talked about before, which is the so-called non-banks out there, and the difference between them and the banks and the growth of the non-banks and what they're doing. One of the things you've pointed out is perhaps a change is they're becoming frenemies, if I could put it that way. They're increasingly cooperating one with the other. And I wonder what ramifications that might have for the system, particularly not understanding the way you do, whether in fact systemic risk could come in through the back door.
Yeah, I'm not sure I understand it either, David, which probably I understand the scope of it. And I think that points to maybe the biggest issue right now, which is one of having the data, the information to make an evaluation on this. Do the agencies, both domestically and internationally, know the degree to which, a hedge fund or a private credit fund has credit relationships, contingent funding relationships with banks, the degree to which asset funds may take some of the synthetic risk that's being transferred by the banks, the derivatives counterparty relationships. I don't think we've got the kind of information in the form that's needed in order to make an assessment there. And one doesn't want to be alarmist, but obviously the trend towards more interaction between non-banks and banks has continued. And the Financial Stability Oversight Committee in the US, the Financial Stability Board internationally, are just going to have to do more to try to get their arms around exactly where the risks may arise.